Hello, everyone. Welcome to the webinar. We are so thrilled to have you with us today, and we have a wonderful presentation coming up. I'm glad to see many of you have registered to learn a little bit more about Delaware Statutory Trust today. For those of you who don't know me, my name is Alexandra Alvarado. I'm the Director of Marketing and Education at the American Apartment Owners Association. And we have with us today Alex Madden from K Properties and Investments. He's their Vice President. He joined K Properties as a DST, Delaware Statutory Trust expert, and he helps clients navigate those nuances and all the rules that surround that unique investment universe. Prior to joining K, he was a specialist at KPMG's Management Consulting Federal Advisory Practice, where he consulted for HUD, the Department of Housing and Urban Development, and the FHA, Federal Housing Authority, specifically in the multifamily and single family space. So he's been in the rental industry space for a while and is very much so familiar with it. We've had K Properties speak before, but this is Alex's first time speaking, and we're very excited to hear his take on Delaware Statutory Trust. Just before we start, want to let you know that we are recording this whole thing, and we will be sending it to you tomorrow along with any slides and Alex's contact information and K Properties DST toolkit. So we'll share that with you later on in the presentation. And I hope you'll also stick around for the Q&A. You can put your questions in the Q&A box if you have them and not the chat so we can keep track. We'll be sure to stick around to answer those. And I hope you all will learn a little something new or get a refresher today from Alex. Thanks, Alex, for coming on and talking to our group.
Absolutely. Thanks for having me, Alexandra. I will go ahead and share my screen here. All right. So as we discussed, today we're going to be going over how to replace debt in the 1031 exchange. Some brief risks and disclosures. I really do want to encourage everybody to read these. DSTs are only available to accredited investors. And there's material and specifically private placement memorandums for every DST, which you need to go ahead and read prior to investing. There's no guarantees in DSTs, just as in real estate. And please go ahead and take a minute and capture this screen here. This would be very useful information. All right, so briefly about K Properties and Investments. K Properties helps investors choose 1031 exchange investments that help them focus on what's truly important in life. That could be their kids or grandkids, travel, hobbies, other business endeavors, basically everything other than the terrible T's, right? Toilets, tenants, and trash. And so we've helped 1031 exchange investors for nearly 2 decades free themselves of the burden of active property management. We've helped investors do exchanges into over 9,100 1031 exchange investments. So certainly experienced in this space. A little bit more. We're experts within the real estate investment firm specializing in the Delaware Statutory Trust investments for 1031 exchange investors. Collectively, our team has over 340 years of real estate experience and have helped over 2,270 clients purchase over 9,100 DST investments nationwide. K Properties and Investments has participated in more than $39 billion in DST real estate investments. The KPI1031.com platform provides access to the marketplace of typically 20 to 40 DSTs from over 25 different DST sponsor companies. And you got a great shot of the company there from one of our recent gatherings. So DSTs as a 1031 exchange solution. I think it's helpful just to go ahead and level set so everybody kind of knows what we're talking about. DSTs have certainly grown in prevalence over the last 5 or 6 years, but still from time to time, you get folks who don't know much about DSTs. So overall, DSTs, they're going to be a compelling blend of convenience, risk mitigation, diversification, making them attractive as a potential 1031 exchange replacement option. Some of the pros, they eliminate the day-to-day headaches of property management. No more of those terrible T's we discussed. The portfolio diversification by geography as well as property types. I'll say this once and then kind of skip it for the rest of the time, but diversification does not guarantee profits and does not guarantee protection from losses. It is a financial principle and not a guarantee. Um, Also, the long-term non-recourse financing locked into place to satisfy the value of replacement requirements for the 1031 exchange. Of course, this is a subject that we will flush out a little bit more throughout this webinar. Gives access to institutional grade real estate. A lot of our investors probably could not purchase these DSTs, the same exact properties all by themselves. However, using the DST model, they can purchase a piece of that property. We do have some clients who actually could purchase these assets all by themselves, and they choose not to for the diversification that's included in the DSTs. The ability to close on a DST 1031 exchange property within 3 to 5 business days, something that's virtually unheard of within the real estate markets, being able to complete a purchase within 3 to 5 days. So what are the basics of a 1031 exchange requirement for full tax deferral? You must use a qualified intermediary. From time to time, I've got somebody who will give me a call and they say, I just sold my property. I've got the money. I'm ready to do a 1031 exchange. And I say, well, just to clarify, your qualified intermediary has the money, right? And they say, no, I've got it in my bank account. And that's a very sad conversation to have because that is a taxable event. You must get a qualified intermediary prior to receiving positive control of those funds. In fact, you must never receive positive control of those funds. It must go to an intermediary. I've actually helped investors who have given me a call at the closing table, and they did not have a qualified intermediary set up, and within about an hour or so, we had it set up. Don't recommend doing that. So if you have the option, and we all do, get that intermediary set up ahead of time. So moving on to the second rule here, you must reinvest 100% of the net sale proceeds of the replacement property. An example here from time to time, I'll have somebody say, well, I'm selling $1 million property and I know that I need to buy $1 million worth of real estate. But what if I go get a big loan, let's say a 90% loan to value, and I'm going to use $100,000 with a 90% loan to value. I'm going to go buy $1 million worth of real estate, and I'm going to pocket that 900,000 and go do whatever I want to do. That is kind of what this rule is touching on. You are not allowed to do that. You must reinvest the net sales proceeds for a full tax deferral of your 1031 exchange. Moving on to rule 3 here, purchase an equal or greater value replacement property as they have on the relinquished property. So what that's saying, again, if your net sales price is $1 million on the sale of your property, you need to buy at least $1 million worth of real estate. And so if you do not, you could face a potential tax liability on whatever you do not replace. Moving on to rule 4, you need to identify a replacement property within 45 days of closing escrow on the relinquished property. So sometimes people will say, well, I'm closing in 45 days. I'm under contract, just got under contract. It's a 45-day close. So I need to get everything set up before my closing. And while it is prudent and wise to get everything set up prior to your closing, that's something that we can certainly help you out with. The requirement is from the close of escrow of your relinquished property. So from the closing table of your relinquished property starts that 45-day timer. And then moving on to the following rule, closing on the replacement property must be the earlier of either 180 calendar days after the closing of the sale of the relinquished property or the due date for filing the tax return for the year in which the relinquished property was sold, unless automatic filing extension has been obtained. So the second component there that you need to be aware of is that you need to complete your exchange before you file your taxes for those years. If you have particular questions regarding to tax filings and 1031 exchanges, I just want to say outright that I am not a tax professional, and so would highly recommend that you discuss that specific aspect of it with your tax team. But generally, the concept is 45 days from sale, you need to identify. 180 days from sale, you need to actually complete that purchase. And importantly, it's 180 days from sale. And so it's 135 days from the closing of the identification. Yes, I know there's a lot of numbers there, but just to clarify, 45 days to identify, 180 days to complete the holdings. All right, so the 1031 exchange value replacement rule. And I think that this is important to understand as we get into debt replacement because it's very relevant. So the 1031 exchange requires investors to fulfill one crucial value replacement rule: equal or greater value. So the value replacement rule in the 1031 exchange requires the value of the replacement property to be equal or greater than the value of the relinquished property. Any cash or debt not reinvested, known as boot, is subject to capital gains tax. And so sometimes we can get into what we might call a partial exchange, coming back to our $1 million sales price. If you sold for $1 million and you purchased $800,000 worth of real estate there, then the $200,000 difference is going to be potentially taxed and so we'll kind of get into how this creates some nuance within debt replacement. So the 1031 exchange investors often choose Delaware statutory trust properties because replacing debt using a DST is remarkably straightforward compared to qualifying and closing on a loan of your own. I'm sure everybody listening here at some point has gotten a mortgage and you realize it can be a rather onerous task. And the bank, wants documents and credit reports and statements and, everything. So you're not going to see that within the Delaware statutory trust. So investors use DSTs for debt replacement because it's pre-arranged debt. With Delaware statutory trust, the debt component is already structured and in place to satisfy debt replacement requirements of the 1031 exchange. Because DSTs allow investors to purchase a fractional interest in the DSTs, and because DSTs have a variety of financing ratios in place, which we'll cover, investors don't need to secure new financing, undergo personal credit checks, or provide extensive financial documentation to the lender. So prior to any investors purchasing a DST, the loan has completely been set up. It's going to be a typically non-recourse loan to the investors held at the DST level. It is non-recourse to the investors. It's not going to show up on your personal credit report. And so it's all set before the first investor comes in. DST properties have non-recourse debt. A non-recourse loan is a type of debt that is secured by collateral, but limits the lender's recourse to that collateral if the borrower defaults. In other words, the lender can't pursue other assets of the borrower to collect the debt. For example, if a borrower defaults on a non-recourse apartment loan, the lender can only foreclose on the apartment and can't take any other legal action to collect the debt. Again, it's secured by that asset. And so in a non-recourse loan, the lender would have no recourse to come after DST owners with their personal liability, unlike what many of you have likely experienced in taking out a mortgage, whether it's commercial or residential, in that you are typically going to sign your name for that. And as such, the bank, the lender, can come after virtually all that you own in order to collect on that. And so in any investment, there's risks, but with a non-recourse loan, the lender risk is going to be typically limited to the asset itself. So the types of leverage available in DST properties. There are traditional DST leverage. This is usually going to be in the 30 to 55% loan to value. And different times, different lending standards and requirements. You'll see them kind of grouped, usually a little bit more closely. Then we have more highly leveraged zero coupon DSTs, which we'll kind of get on into what zero coupon DSTs are, but in short, they're very highly leveraged, usually in the 70 to 90% loan to value range. And then we have a third category, which is 100% debt-free DSTs, which is to say no mortgage on them. So let's do a couple scenarios here. Let's say that you sell your property for $1 million with a $500,000 loan on it. You find a replacement property that is selling for exactly $1 million. In this case, you can reinvest $500,000 of equity from the sale of your down leg, the relinquished property, and apply and qualify for a new loan to replace the loan of $500,000. The result is you have now replaced $1 million value requirement. This would be a 50% loan to value. Because 50% is equity that's coming from the investor and 50% is equity, or rather debt that's coming from the lender. So in a traditional leverage, 30 to 55% loan to value, K Properties works with many different Delaware statutory trust sponsor companies that have properties with a variety of loan to value ratios. From our observation, the typical loan to values of DST 1031 properties range from 30 to 55%. There are DSTs, on either end of that. I would say that it's definitely true that the vast majority are going to fall within that number, though. But occasionally, you'll see something that gets up into the high 50s, maybe even low 60s. Occasionally, you'll see something, down in the 20s. But 30 to 55% is pretty normal. I would say for right now, if I had to kind of tighten that up a little bit more, a lot of them are going to be in the 40 to 52%, plus or minus. If you really force me to, but 30 to 55% is pretty normal. A DST 1031 property with a 50% loan to value means that the investors will be putting in half of the required equity amount to purchase the DST interest, and the lender is providing the other half in the form of a non-recourse loan. K Property is a leader in providing investors access to DSTs with additional financing, typically in the 30 to 55% loan to value range. So if we kind of take a step back and think about purchasing a normal, say, single family residence, again, using a nice, round number, if we were to do, the typical kind of 20% down scenario on a $1 million home, then 20% would be $200,000 down. The bank would be lending the other $800,000. That would be an 80% loan to value. Now the investor owns the full $1 million home, but at an 80% loan to value. So here's a hypothetical investment example. In this scenario, consider a 1031 exchange investor who recently sold a commercial property for $1 million, which included a $500,000 loan. This investor must invest the full $500,000 of equity, as well as achieve a minimum $1 million reinvestment value for the 1031 exchange rules. So looking at this table here, I think it's helpful to all kind of orient you here to this table because we'll use it in some subsequent slides. In the left column, we've got the property name, for example, the Texas multifamily DST, the 1031 equity being invested. Here, this is $500,000. So, basically, in the scenario, the property was sold for $1 million, $500,000 loan, right? So at the sale, $500,000 went back to the lender, and $500,000 went to the qualified intermediary. Now, with the $500,000 at the qualified intermediary, you need to buy $1 million worth of real estate. So this 1031 equity in this column is the equity that would be coming from the 1031 exchange, and more specifically from the qualified intermediary. The loan to offering is 50%. So 50% of the $1 million purchase, the projected loan amount is $500,000. So if we add the 1031 equity with the projected loan amount, we've got the projected total purchase price of $1 million, just for orientation sake. So in scenario number 2, let's say you sell your property for $1 million with $500,000 loan on it. This is a scenario where we're going to go over adding cash because I think very importantly, kind of touching on the earlier requirement, a lot of people use the term debt replacement as a rule, and it's actually not a rule, as we've covered. The rule is purchasing equal or greater value. So if you sell for $1 million, the rule is you need to buy $1 million worth of real estate. Now, some people, can and want to come out of pocket, and they do not want to take on a loan in that scenario. So that's what we're gonna cover right here. You find a replacement property that's selling for $1 million because that's what you need to purchase. You sold for $1 million, you need to buy $1 million. So reinvest $500,000 of equity from the sale of your down leg, and so that would be the funds coming from your qualified intermediary, and then add $500,000 cash out of pocket for those who don't want the risk of debt. As I'm sure we all know, anytime that you've got a loan on a property, that potentially represents the largest risk on that property. Now, because the lender has legal rights, has legal recourse against that property typically. So the result of coming with 500 from your 1031 exchange, 500 out of pocket, is you now replace $1 million value required and have no risk of lender foreclosure or other issues that come using debt. So the types of leverage available in DSC properties for 1031 exchange investors. Another category is this debt-free loan to value. And so it means that the DST has no loans, no mortgage associated with it. And so this reduces any risk of lender foreclosure because there's no lender associated. So the K Properties is a leader in providing investors with access to debt-free DST investment options. Why would somebody consider a debt-free property? Well, there's no refinancing risk. There's no cash flow sweep risk. This is something that I think a lot of times people can be surprised by in most commercial loans, in particular, investment loans. There's usually going to be a provision for a cash flow sweep, and the circumstances vary for what it is, and it might be occupancy. If you fall below a certain level of occupancy, it might be a certain tenant in a commercial property. If you've got a multi-tenant commercial property, and they might say, okay, if such and such a tenant, if they move out or if they do not renew their lease, the lender is going to go into a cash flow sweep situation. And that's not a foreclosure, but what it means is that the bank is going to take all of the revenue and they're going to go ahead and put it in a lockbox. And they're basically securing their own investment there, right? Their own loan. And so in a scenario, it's a cash flow sweep, even though there's still rent being paid to the landlords, there's no funds to be distributed to the investors as a provision of the actual lender's loan documents. So by going debt free, you've obviously eliminated that risk. There's no risk of taking on equal or greater debt in future exchanges. This is one that I always try to explain to people. There's potentially pros and cons associated with taking on more debt than you need to. In most circumstances, I would personally argue that the juice isn't really worth the squeeze, largely because if you take on debt in this 1031 exchange and we fast forward and this DST or whatever property you buy is sold in the future, you now have that equal or greater value provision. So if you bought for say you were debt free on a $500,000 property, you didn't need to replace any debt, but you invested in a DST that had a 50% loan to value. Well, again, you're investing $500,000 of equity, as a result of the 50% loan to value, you're taking on $500,000 of debt. Your total purchase is now $1 million. And so when that is sold, and let's just say for easy math and the sake of this example, it's going to be sold for $1 million. And so now you have to pay back the lender $500,000, and $500,000 goes to your qualified intermediary. Well, now you have a requirement to purchase $1 million instead of the $500,000 that you originally had a requirement for, because you have an equal or greater value provision. So somebody might go into a debt-free DST in order to avoid the requirement to take on equal or greater value of their purchase in the future. Also, there's no balloon mortgage maturity, typically found in leveraged DSTs. A lot of you are probably familiar with the concept of a balloon loan. No cross-collateralized loan risk found in certain leveraged DSTs. Usually, a scenario would be a diverse portfolio of properties. Say they're commercial properties, maybe 20, 30 different commercial properties all across the country. And they're diverse businesses, lines of industry, virtually unrelated, except they have a loan, a single cross-collateralized loan, which means there's one single mortgage that covers all those properties. Well, if one of those tenants in an unrelated industry, goes bankrupt or has some sort of an issue, because this loan is encumbered across all the properties, a potentially catastrophic situation for one or more of those tenants could put all of the other properties at risk, even though they otherwise would not be at risk, separate industries, separate states, whatever, but it's a cross-collateralized loan all across one. Also, there's flexibility to hold through potential market downturns, credit crunches, recessions, and depressions. A lot of times you'll see, a distressed seller because for one reason or another, they have to sell that property. And when there is a lender involved, you have another very influential party to this transaction, and they're looking out for their investment, which is the debt on this. And so if there is no debt, if there is no lender, then you've got much more flexibility. If there's an extreme downturn, there would be no, lender requirement to sell that property to save their loan on the property. And so, just a lot more flexibility in those kind of situations. And then lastly, protecting investors from financial catastrophe of a complete loss of their principal due to lender foreclosure. Obviously, if there's no lender, there's no possibility of a lender foreclosure. All right, so let's look at another scenario here. Consider a 1031 exchange investor who recently sold a commercial property for $1 million, which included a $500,000 loan. The investor prefers debt-free Delaware Statutory Trust, so they must invest the full $500,000 of equity, as well as contribute an additional $500,000 of cash to achieve a $1 million reinvestment value per the 1031 exchange rules. This is kind of the scenario that I covered already, but it is in the equity column, right? We see 500,000 of 1031 equity, 500,000 of added cash or cash out of pocket, the projected total purchase, of course, that being 500,000 each for each of those line items, with a $1 million total purchase. So that would be going from having a loan to not having. So let's say you sell your property for $1 million with an $850,000 loan on it. So in this scenario, we've got a pretty high loan value. And so you need to find a replacement property selling for $1 million. In this case, you can reinvest $850,000 of equity from the sale of your property. Actually, this is actually wrong here. So we want to reinvest in this scenario $150,000 of equity from the sale of your down leg, and apply and qualify for a new loan to replace the $850,000 of mortgage. So the result is you have now replaced $1 million of the required value. So the way that you would do that is with a zero coupon DST. Just quick brainstorm. Sometimes people who are not in this situation ask, well, how would that be possible? How would you end up in that scenario? And there's a handful of of different circumstances that could have resulted in that. Sometimes it's the dissolution of a partnership, and results in changes to loan agreements and that sort of a thing. Another circumstance would be like a cash out refinance. If an investor owned a property and did a cash out refi, in the semi recent future or past rather, then they might have a very high loan to value, and for whatever reason they're choosing to sell that property and they would like to defer the taxes using the 1031 exchange. So those are kind of some of the common ones. I'm sure there are others, but in that scenario, we might use a zero coupon DST. This is a highly leveraged DST property, typically in the 70 to 90% loan to value range. In the world of Delaware statutory trust, highly leveraged DST properties are called zero coupons. A zero coupon DST allows investors to replace a large amount of debt with a relatively small amount of equity. K Properties is a leader in providing investors with access to zero coupon DSTs. So a closer look at zero coupons. One important thing about a zero coupon, a DST, is that it offers zero cash flow to investors. While the asset is potentially producing cash flow, rent from the tenant, there is no cash flow to distribute to investors once the mortgage principal, interest, and taxes are paid out each month. Hence the term zero coupon. Zero coupon DSTs are quick and efficient ways to replace a large amount of debt in a short time frame with a relatively small amount of equity. So looking at a scenario here, consider a 1031 exchange investor who recently sold a commercial property for $1 million, which includes a $850,000 loan. This investor must replace the full $150,000 of equity as well as achieve a minimum $1 million reinvestment value per the 1031 exchange rules. So in this scenario, we've got $150,000 coming from 1031 equity. The loan, the offering size is 85% loan to value. The projected loan amount would be $850,000 with the projected total purchase price at $1 million. Before we get into another example here, I've had a number of different clients who have used zero coupons in tandem with either debt-free DSTs, which we'll cover on the next slide, or also with leveraged DSTs, where they'll put a small portion into a zero coupon just to kind of get a little bit of a bump on their loan to value scenario. And then I've had some that have used it completely for their debt replacement and then gone and bought non-DST properties for the remainder of their equity. So you're basically using the zero coupon to quote unquote trap their debt in the DST in a non-recourse long-term loan kind of a situation. So in this scenario, we're going to evaluate how you could use a zero coupon to replace your debt and then go into debt-free DSTs for the remaining proceeds. So consider an investor who recently sold a multifamily property for $1 million, which did include a mortgage of $200,000. The investor aims to protect the bulk of their equity from lender foreclosure and cash flow sweep risk by utilizing debt-free DSTs for a majority of their 1031 equity and a small amount into a zero coupon DST for debt replacement. So coming back to our table, you see we've got 3 debt-free DSTs on the left and 1 zero coupon DST. We're looking at a $250,000 investment in the 3 debt-free DSTs with a $50,000 investment in the zero coupon DST. In this scenario, the zero coupon has an 80% loan to value. Of course, the debt frees have a 0% loan to value. This results in the projected loan amount of 0 coming from the debt-free DSTs and $200,000 coming from the zero coupon. So coming over to total purchase price, if you invest $250,000 in a debt-free DST, you're buying $250,000 of total real estate. Now, coming down to the very bottom row here, if you invest $50,000 in a zero coupon with an 80% loan to value, you're actually buying $250,000 worth of real estate because you've got the $50,000 of equity that you put in, and then $200,000 on the loan. These are, somewhat nuanced situations, and so we definitely would encourage you to book a call with the K Properties team. You can contact us on our website, kpi1031.com, or by calling 855-899-4597. One last scenario here that I'd like to cover is, not using a zero coupon. But I've had a few clients who have done this, but I had a client who did this, somewhat recently, and he sold about a $10 million property. He had about $3 million of debt on it, and he used cash flowing DSTs. Most of them were in the 40 to 50% loan to value range. For his debt replacement, he wanted access to the non-recourse financing associated with the DSTs. He did not want to, go through the whole loan process, and so he used DSTs just for his debt replacement. He went and he bought. He was, very very sophisticated investor. This was not his only, $10 million transaction that he had done recently, and but he just wanted to go buy other properties completely debt free that he was going to be managing himself. So we can see for people who want to be hands on still. They might even make sense to consider DSTs for debt replacement because of the potential ease it is to get access to that loan. So please go ahead and before we go into questions, quick plug here. Reach out to us on the KPI1031.com platform. You can get free access to typically 25 DST sponsor companies, leveraged, debt-free, and zero coupon DSTs, typically 20 to 40 different DST offerings available. We also have opportunistic and income-oriented real estate funds for direct cash investors, as well as qualified opportunity zones or QOZs for other tax smart investments. Register today at KPI1031.com. We can get you access, free book, free magazine, other educational conference calls. We do weekly webinars, and we do different DST 1031 dinner events. So our entire team is here to assist you. So please do not hesitate to reach out. Thanks again for your time. We're going to go ahead and we're going to do a little a poll here. So if you would like a free Delaware Statutory Trust Toolkit, this includes a subscription to the 1031 DST Digest magazine, a copy of the Delaware Statutory Trust Properties book, and a free current DST 1031 Exchange Property menu, please go ahead and click that yes, and our team will go ahead and get that out to you.
Great. I'll leave that up there for just a little longer. And we did get some questions, so I'll start with those. Gerald asked, are DSTs only for 1031 exchanges? Can they be used for replacing existing financing?
So to answer that first question, no, you can the old adage, cash is king, right? So you can purchase DSTs with non 1031 funds in most circumstances to include retirement accounts, and as well as, of course, 1031 funds. And then K Properties, we have other non-DST investment funds for consideration. Those are not going to be 1031 eligible, but something that we can discuss if you'd like to.
Great. Dave also asked, what is cash flow sweep risk?
Yeah, so the cash flow sweep risk is going to be kind of subjective. I hate to say it depends. I got to give you the CPA answer, but really what it's going to come down to is the terms of the loan. It's typically a provision that comes from the lender, and so usually it will include some sort of a trigger. Could be occupancy based, could be lease term based, and basically what it says is if this event happens. Or if this event does not happen, depending on kind of the inverse of the situation, then the lender has the rights to sweep the cash flow. And it's known as like putting it in like a lockbox, right? Where they're going to set it aside. It doesn't mean that they get to keep it. it is usually going to be the landlord's funds, but it's basically securing the loan. So in the in the event that the property with the loan attached to it was sold for less than the remaining loan balance, then the lender would have access to the locked funds. So basically, they're saying we're going to get our loan back, and as a result, unexpected or unforeseen, unanticipated thing or undesired thing happened. And so they're going to secure their loan first. If the property is sold and the loan is is paid back to the lender, no issues, no problem. Typically, that would be distributed back to the landlords.
Okay, great. Gerald also was asking, it was towards the beginning of your presentation. I believe it was an example. Can the $200,000 difference be used to purchase another like investment?
The $200,000 difference. So I don't recall exactly the scenario. I know we kind of threw out a bunch of different examples throughout this, but in short, the requirement, the big relevant requirements are using all of the funds and purchasing equal or greater value. And so you can do that using debt replacement, like we've discussed. You can do that by adding cash, like we've discussed. But you could purchase DSTs and non-DST properties as long as it's 1031 eligible. Then there's no requirement that you have to purchase just one property, or if you go into DSTs that you have to do all DSTs. That's not a requirement.
Yes, he did clarify, and I think you just answered it. Can I sell a $500,000 property and purchase two $250,000 properties? So yes. He also said he stated that if you did not use all the funds, the remaining is taxable, but can it be used to purchase another like investment? Yes.
Yes, yeah, absolutely.
Sure. Or
So
DST. I think that's where the DST comes in handy because it doesn't have to be a whole property. It can be a smaller amount to kind of make up that difference there. Um,
Yeah, exactly. And just to kind of flesh that a little bit more, sometimes like I mentioned a couple different examples, investors will use DSCs just for the debt replacement component. But other times investors may have a sweetheart deal, where they think, gosh, I just can't pass up on this opportunity. I sold my property for $1 million, but this real sweetheart deal is $850,000. What am I going to do with the remaining 150? And so that's what we would call a cover scenario. We'll cover the remaining amount that you got a great property that you want to buy. But a lot of times, like, what are you going to go do with 150,000? And so being able to use cover that remaining exchange funds.
Well said there. TNC landlord says, if I sell a $1 million property but have a $500,000 note, how much do I have to reinvest? 500,000 or 1 million?
So in that scenario, you need to purchase equal or greater value from what you sold. So if your net sales price was $1 million, you need to buy $1 million worth of real estate. Now, the rub and kind of the basis of kind of what we've been discussing is that in your scenario, you only have $500,000 in order to buy $1 million worth of real estate. So the question kind of comes back to you: do you want to come out of pocket with $500,000? Which a lot of people don't, in that scenario. So the advantage of something like a DST is that loan is completely structured, secured by the asset, non-recourse financing, and investors could use that to replace the $500,000 loan that they had and complete, in your example, the $1 million purchase.
All right. Yeah. He also asked if I have a fourplex and sell for $3 million and have a $500,000 note, can I buy multiple single family residences or a duplex or a triplex? And do your folks do that, or is that just the DSTs that Kay helps out with?
Yeah, so I think you're kind of getting to the nature of, what does the IRS call a like kind? And so the IRS generally considers it to be like kind if it's used for business or investment purposes. So you could sell a duplex and buy farmland, timberland, or a gas station, or a DST, or another duplex. But don't get trapped thinking I sold a duplex, I got to buy a duplex. Um, and then with regard to, what do? We are DST specialists. And so, we are experts, although we have our securities licenses to sell a lot of other, securities products. We specialize in DSTs. The IRS considers DSTs to be quote unquote real property, which is why it's eligible for 1031 exchange. But we believe that this industry really warrants specialization. There's, knowing the business plan, the risk factors, who the different operators are, who's who. So we're here for all your 1031 exchange needs.
Great. And I think just one last question here. Who then leads the projected loan amount in the hypothetical example?
Sorry, who leads it?
Sorry, I misread that. Who lends the projected loan
Oh,
amount? That changes things.
yeah. Sure. Um, so it could in short, it's a lender. But who is the lender? Well, depends on the property. Could be a bank. Often it's a bank. Could be some other kind of lending institution. There are companies that lend. Um, there's CMBS loans, commercially backed mortgage securities that can provide loans from private companies and whatnot. But most often, DST sponsored companies are, and this is not a hard fast rule, but it's very common that they're looking to create loans that are going to be insured by Fannie and Freddie. And so it's desirable to just like with single family that I'm sure most people are kind of more familiar with is the objective is to have Fannie Mae, Freddie Mac, Ginnie Mae, whoever that's able to provide mortgage insurance, which means better rates, so on and so forth. So same kind of thing, could be a variety of different lenders, but usually they're going to be working towards conforming to those Fannie Freddie standards.
That's great. So I know we covered a lot of ground. I don't see any more questions coming up. So I think we can close it out here. Alex, that was really informative. Thank you for sticking around for the questions. We'll be sure to send everyone the recording and the information that we shared today with you in the follow-up email that I'll send tomorrow. So stay tuned for that. And I hope that you'll also join us for our rental housing conference on October 16th. There's a question in the exit survey. If you all want to attend and you say yes, I'll save you a spot. We do have it live streamed online. And if you're nearby California or you want to hop in and have a little week in Long Beach, California, we'll be there. So in person or live stream online, let me know. And let me know also your thoughts on this presentation. Alex, thank you so much for your time. Again, wonderful coverage of all the information.
Thanks so much. Pleasure to be here and hope to be back again.
All right, everyone. Take care. Bye.
Take care.